Welcome back to Switzer on Australia's business channel. Now, self-managed super funds continue to represent the largest segment of the super industry, with new figures from APRA revealing a 7% rise last financial year alone. But what should you consider when thinking about starting a pension in your self-managed super fund? Now, by the way, you might be thinking, oh, that's for old people. But people age 55, and they're not old people under my reckoning, they can get a pension. Joining me in the studio with more is Sinclair Taylor, Westpac's head of self-managed super funds. Mate, how are you?
Good, thanks, Brett. How you
Now,
going?
I know you agree with me, 55-year-olds aren't old, are they?
Not at all.
No, they're your favourite customers.
They are. They are, actually, yeah.
Yeah, and so the thing is people forget about transition to retirement pensions. They can start at 55. And so I'm going to ask you tonight, the ins and outs, so the things that people should be thinking about when they start.
There's a lot to consider if you're going to kick off a pension. And remembering, of course, the pension is what is at the end of the rainbow. That's the pot of gold that you've been building through accumulation phase to get to the drawdown piece. And the sole purpose of super is, of course, to fund your retirement. A key way to do that is to take money out in pension phase. You've got about a third of Australia's superannuation funds, or SMSFs, now in pension phase already. And of course, that number's going to keep on growing as more and more baby boomers leave the workforce over the next couple of years. So now's the time to really consider, as a trustee of your own SMSF, what am I going to do with my pension? And get it kicked off in the appropriate way.
I haven't seen any data on this, and I guess you might not have, but because you're close to the industry, you might have. The number of 55-year-olds who've actually taken a transition to retirement pension, I would reckon the percentage is actually quite low. What do you think?
Look, I think a lot of people off the back of the GFC have re-entered the workforce or have stayed in the workforce for longer. And the transition to retirement pension is a newish concept, and it does allow people to, as you say, start accessing some of the superannuation benefits but keep a job going. And that really allows you to top up that income that you might be earning on your day job, but equally it might allow you to step back a bit and spend more time with the grandkids, or pursue another hobby. Yeah,
because some people actually go from full-time work to maybe three-quarter type work, and they take a little bit of extra money out of the super. But the big appealing part of it is, I think a lot of people don't think about, is that the amount of money you got in your super fund, the day you start the pension, it transfers into pension mode, and that then it becomes tax-free on the earnings of it.
It does.
And that's a really important point. A lot of people haven't thought about it.
It is, that's right. So on the way through, in accumulation phase, it's 15% is the tax rate that you're paying. Drops to zero, as you suggest, but of course, the government has signalled that 1 July 2014, pension income over $100,000 will stay at the 15% tax rate, so it'll lose that exempt income status that it currently has. So that's certainly a big change if that rolls through. But yeah, the current regime is very generous and exempt income.
The coalition haven't jumped on that one. It hasn't been. Has it been passed into legislation? No. And the coalition hasn't actually said they're going to support that. But we don't really know at this stage, do we?
We don't know. We don't know. But it's certainly something to be mindful of. And when you're going to kick off an SMSF pension, things to really consider are: is the member eligible to start one? That might sound really fundamental, but have you got the ages right? You know, are you over the age of 55? So have you met one of the preservation rules that enables you to access super legally? Obviously, some people might be tempted to access it illegally, but we're interested in people who want to access it in the right way. Can they demonstrate to the trustees of the fund, i.e. themselves, that they meet those requirements? Likewise, does the fund enable you to actually pay a pension? And the trustee to the fund sets out whether that's permissible or not. A lot of old trustees possibly don't contemplate transition to retirement pensions. They just won't around, and hence the drafting of the deed needs to be amended if you want to go down the TTR path. Also, it's certainly worth considering the fund's investment strategy. Does the fund's current strategy support payment of a pension? Does it generate enough income? Do you have enough liquid assets? And can you make those minimum pension payments each year? So it's certainly a number of things to consider.
Yeah, and I guess if you're in an industry fund or in a retail fund, there would be services set up to answer all those questions, because they're frequently asked questions. But when you're in a self-managed super fund, you are in a sense operating on your own, and of course there are, like, your website explains it, so there's my Switzer Super Report as well.
The ATO as well.
The ATO as well. And people should be asking those sort of questions, and I guess under some circumstances they actually should have a third opinion by an expert on the best way of doing it.
This is a fairly complex area of legislation.
Yeah.
If you get it wrong, there are severe penalties. And
yeah, your
that's
fund can be...
That's not to deter people,
no.
But certainly get good advice. If you're not sure how to kick it off and what to think through, get professional advice. Likewise, if you've already got a pension underway, make sure you're doing the right thing. Make sure you are meeting those minimum payments, for example.
Yeah, and I guess there are other little strategies that come along where, for example, when you're in transition to retirement pension, you can draw out a maximum of 10% per year. And some people actually draw 10% out, and they might only want to use 3% of it, and the other 7% they recontribute back, which makes it a non-concessional contribution, which can be a clever strategy, can't it?
Yes, there are certainly some interesting strategies to consider, but once again, they all need good advice. The key thing to consider, certainly account-based pensions, or all of the pensions, you need to think about the minimums. You've got to pay the minimums per annum. They start at 4%.
Yeah. They dropped down during the GFC, but they've got back to 4% now.
They have, and they escalate year on year. So as you get older, initially in a 10-year age bracket, but for example, once you get to 69 plus, it does start to ratchet up fairly quickly because, of course, the ATO thinks you're not going to live that much longer.
They're harsh like that.
They've got to whittle it down.
Okay. Any other rules for pensions that we should be aware of?
Look, this is really about good record keeping, so making sure that you've got very good records. You also need to think about segregation of the fund's assets. If you've got a member who's in pension phase or about to kick off a pension, and you've got another member or members plural who might be in accumulation phase.
And like your kids often are.
Yeah, absolutely. Or you've got one spouse who's over the right age to start a pension and the other partner isn't. You need to separate those assets out, and you need to make sure you've got good valuations done, so you can be very clear, and obviously your accountant can help with this, as to the tax regime that might apply to certain assets and income, and equally the exempt income which will apply to the pension member.
People sometimes ask me, well, I'm the trustee and I've got to inform the trustee, so how do I do it? Have you come across that question?
It does sound like a little bit of a fiction, but this often involves you writing a letter to yourself. Yeah,
or emailing
emailing yourself.
Unless you've got a record of what you've actually decided to do.
That's right, and the fund's auditor every year will look for these written documents. So these base documents, as silly as it sounds, you have to write to yourself.
It's terrible if you have a split personality, where on one hand you ask for the money and the other person says, no, you can't have it.
No, that's right. So hopefully you've got good intentions and you're going to have a sensible conversation with yourself about how much you can take out.
Okay. The ATO. So you said the minimum is 4%?
That's right. Yeah. That's right. So look, by the time you get to 95, it's about 14% per annum. So
they're really tough on 90-year-olds, aren't they, the ATO?
Look, I'm not sure how many 95-year-olds we've got in SMSF, but look, all jokes aside,
we will have plenty in the future.
We will definitely have plenty of people, an ageing population, and we are all living longer.
Okay. So what advice would you give based on the experience of seeing many customers that make the switch from an industry fund or a retail fund to a self-managed super fund?
Look, rolling over, and to your point, it's very common that people will accumulate inside an APRA regulated fund, an industry or retail fund, and make the dive into SMSF just pre-retirement. Yeah,
and they feel as though they've got time to manage it then,
That's
don't
right.
they?
It's, so a lot of trustees in this space are highly self-directed. They want to take the time to manage their own fund, and they're the types of people who should be in SMSF, who've got the time, the skill, sufficient fund balance. But if you're going to kick off a pension, as I said, it's really about getting good advice. It's about understanding the rules around the procedural aspects of paying a pension, but as importantly, does my strategy support it? If I've got things like property inside my fund, property is a very lumpy asset. Depending on the rental yield and the rental flow, you may not be able to actually meet your member payments in terms of pension. So
what you're saying is, and I've come across people like this, they hate stocks, particularly after the GFC, and they might have, say, 400,000 in a super fund, and they think they'll go out and buy a property for, say, 380,000 with only 20,000 left. They actually could be caught short, couldn't they?
They could be, because once again, depending on how stable the rental income is, if you're not generating any rental return, you lose a tenant, for argument's sake, you're not possibly going to be able to make that pension payment. And if you fall below those minimum thresholds, the pension does in fact come to an end, and there are tax penalties associated with that potentially. So
and there are expenses associated with running a property, particularly if you've got an agent involved and all that sort of stuff as well. Yeah,
there are. And look, and certainly there's some additional expenses that the fund members need to consider when you're in pension phase, certainly around some of the accounting aspects of it. If you've got that split someone in accumulation, someone in pension phase. You need to get an actuarial certificate prepared to quantify the amount of assets that relate to each member and how long they're going to last for. And obviously that comes at a cost. So there are some additional expenses that do come up once you go into pension phase.
Are you seeing a big demand for property loans from self-managed super fund customers?
Look, we're seeing fairly consistent growth in our property loan book. And look, it'd be fair to say that property is a very attractive asset class at the moment.
It never used to be, say, 5 years ago. It's really got big over the last 5 years.
Look, it certainly has, and I think for a couple of key reasons. Of course, cash rate is on the decline, and so cash is not as attractive as an asset class. Cash is one-dimensional, and at the moment your cash returns aren't much better than inflation, so you're getting no real return in that sense. It's a very safe asset class. So a lot of trustees are looking for something a bit more secure, with capital growth potential associated with it, and also, as you say, a lot of trustees are wary of stocks. So even though the market is still in reasonable shape and so they had a good bounce this year, a lot of trustees are still a little bit gun shy.
I saw this, I got a question today, in fact, at a conference I was at, and the question was, baby boomers tell me to expect that property prices will double every 7 or 8 years. And my reaction was, well, when baby boomers were 20-year-olds and 30-year-olds, we were seeing that kind of 10% gains. If you get 10%, divide it into 72, there's your 7 years, isn't it? That's where it's come from. But I recently saw data on the 10-year returns, and Sydney property's only done 2.5% over 10 years. So there, if that continues, a doubling rate will take you about 30 years, won't it?
Look, and this is where cash, plays a role. If you're going to go into property, you need to really think carefully about it. It's a very lumpy asset, and you need to think about, is that the right strategy, certainly as you get to pension phase, because it may not provide the growth that it might have done a generation ago.
And so we always have a diversified portfolio.
Definitely have a diversified portfolio.
All right, mate, thanks for joining us on the program.
Thanks, Peter.
Okay, after the break, we'll look at the challenges in the iron ore space and find out if insurance advice is important for small businesses.